welcome to CLTV Podcast. Can I call you as my mortgage guru today?
I would love that. It's the law. You can't get around it if you have less than 20% down. What that insurance is for is it protects the lender if you don't pay the mortgage.
I want you to give me five strategies which a first-time home buyer can follow.
The first is getting that pre-approval as soon as you know that you want to start shopping, because that will make you...
As a seasoned mortgage agent, what would you suggest for someone who is looking for a mortgage? Like one statement.
I think it's really important when you're looking for a mortgage, both to not just focus on the rate, but focus on the solution and make sure you're...
I have just finished a beautiful discussion with Laura. I learned a great deal of information about mortgage, processes, what are the things which we need to do as someone who is applying for the mortgage, and certain tips and tricks for you to get better percentages in the mortgage, and what are the ways how you can apply mortgages for let's say you wanted to build a custom house, or you want to get the best percentage for your mortgage. All these kind of discussions were done in this podcast. I'm sure you would learn a great deal of information if you're a first timer. This podcast is for someone who is interested in buying their first house, who is interested in establishing their business by seeking mortgage help from banks or any other institution for that matter, from any other lenders. I'm sure you will enjoy this conversation if you're into investments, if you're into the first time home buying, if you're into business, if you're self-employed. I try to, we both try to. I've asked a lot of questions and I've got wonderful answers from her. All her contact information will be mentioned in the description. If you want to reach out to her, you can happily reach out to her and get more information. And thank you. Enjoy the conversation with Laura Behm.
Hey Laura, welcome to CLTV Podcast. It's so fantastic to have you here.
Thank you for having me.
Amazing. Laura, I'm going to get directly into the podcast today because you've been in mortgage industry for a few decades, I guess. So based on that, can I call you as my mortgage guru today?
I would love that.
Amazing. All right. So Laura, one of the the questions which I suffer being someone who has come to this nation as an immigrant and trying to find a better dwelling for myself and my family, being a first time home buyer, for example, let's say I'll get you an example here. So if I'm a first time home buyer in Ontario, and how would I navigate through that process? Like, let's say, imagine I'm the first time home buyer, and take me through the process of applying for a mortgage and getting the best amount I'm eligible for, and how do I gauge myself, how much I can get it, this kind of stuff. Can you please take me through that process?
Yeah. So the first process kind of in the home buying journey is finding how much you can be pre-approved for. So we have relatively strict rules in Canada of how much of a mortgage you can get pre-approved for. So that's really the first step in that process. I do recommend people do that as soon as possible. So if you know you have it on your radar that you want to be a first-time home buyer, I recommend that pre-approval happening sooner rather than later, because then if there's something holding you back from buying, we can set you on like the right journey or give you the right to-do list to make that happen faster. I have people come to me that have been saving for a long time, paying down debt, things like that, and then they're ready to start buying. But when we do the pre-approval, we figure out something's wrong, and in order to fix it, we need some time to be able to fix it. So definitely getting that pre-approval as fast as possible and as early as possible.
Amazing. So that's the preparation part of it. So in current day and time, because the real estate market is a bit fluctuating right now, so what are the programs available for first-time home buyer in our nation, for that matter?
Yeah, so there's a lot of great programs, and to be honest, the government has been making some changes since last year to try to make home ownership an easier goal to attain. They have been changing the down payment rules. So they're decreasing the down payment required so that you can get into a home faster. You can stretch out your mortgage to 30 years. Now, previously, you were required to do it for 25 years or less if you had less than 20% down payment. What that does is allow people to be pre-approved for a higher amount because your payments are lower. And then there's a lot of great individual programs like cashback mortgages. You can borrow your down payment, and lots of ways to be able to get that down payment. So you can get money gifted from a family member, things like that. But there's a lot of great programs for first-time home buyers.
Cool. So that's the part when I'm prepared. Now I know what I need to do. Having said that, what is the percentage of amount? Because I know there is 5% and 20%. 5% is the first-time home buyer. He or she is going to put 5% as a down payment, and then take the mortgage insurance, and then you get the whole amount, the whole chunk from the bank. And the second one is 20% down payment, right? So help me in understanding both of these. And one interesting question, because I always wanted to know the answer for this question. Let's say if I take 5%, if I put down 5% and I take a mortgage, insurance, what happens in that process? Let's say if for some unfortunate reasons, if I'm unable to pay my mortgage, what would happen in that? Take me through that one as well. So basically, difference between 5%, 20%, and what happens in mortgage insurance, please. Thank you.
Yep, great. So I hate to do this to you, but the understanding of down payment is actually incorrect. But it's because of the way the media and different people communicate the down payment rules that a lot of people think exactly like you just said. So first, I'll kind of make sure everyone understands the down payment requirements. So first of all, you don't have to be a first-time home buyer to put the minimum down payment. So I've had 2 houses in my life. If I go buy another house and I move there, the minimum down payment rules are the same for me as they would be for someone that's that's a first-time home buyer rule, but it's not. It just, you have to be living in that house in order to do the minimum down payment. Does that make sense?
Oh, okay. So
Yes.
basically,
Lots of people misunderstand that.
then I have a follow-up question on that. And again, I'll go back to the follow-up question is this. Let's say if I live in, for example, I bought my first house in Mississauga. Now I've got my job in, in Bowmanville. Now I want to move to Bowmanville. So I'm going to buy a house there, but I want to keep this house. So I've paid 5% only for Mississauga. But when I moved to Bowmanville, you were suggesting that we can also pay 5% for the new house there. So what happens to this house? Do I have to pay extra 15 because this will become my the first primary house? You understand? I don't know what you call it. So
yeah, I totally understand the example. So first, let me answer what the minimum down payment rules are, just because we also describe it incorrectly, which makes people think the wrong thing. So you actually need 5% down for the first 500,000. So if you bought a house for 500,000, you would need 5% down, 25,000. For the portion between 500,000 and $1,499,999, you need 10% down for that portion. So if you bought a house for 700,000, you need 25 for the first 500, and then you need another 20,000 for the portion between 500 and 700,000. So it's not 5% across the board. It's kind of a sliding scale. First 500,000, it's 5%. The portion between 500 and almost 1.5 million is 10. And then once you buy a house for over 1.5 million, you have to have 20% down.
Yeah, looks like that.
It's very hard to explain that rule because of the whole, part of it is 5%, part of it is 10, but it is a kind of sliding scale, as I mentioned. The higher the house, the more you have to have down. But a lot of people just call it 5% down, which actually isn't the case.
Oh, it's not like blanket 5% or
No.
blanket 20%.
No. It is over 20 over 1.5 million, you have to have 20% down completely. It's not 5%, then 10, then 20. You have to have 20% down once the house is worth 1.5 million. But under 1.5, that's where the first 500,000 is 5%. And then the portion between 500 and 1.5 needs 10%.
Okay, so let's say if I have 1.5, okay, let's go with very bigger example. Let's say I liked a $2 million house.
Yep.
Take me through this. What you will explain, take me through that.
20% down. So you need $400,000.
But I have 500 and one, the amounts which you described. That can't I have 20% for 1.5 million, 10% or something like that?
No, it's as soon as the house is priced at 1.5 million, you have to have 20% down. Like there's no,
okay.
It's straight rule. So $2 million house would need $400,000 down.
That makes sense because to make housing affordable, I guess. Okay.
So
Cool.
now that I'll answer those other two questions you had about the minimum down payment. So let's say you bought a house in Mississauga for $500,000, just to do some easy math, and you only put 5% down at the time. I doubt you could find any house in Mississauga.
I was about to say
that. Yeah, you put $25,000 down, and now you want to move to Bowmanville, and you're going to have your Mississauga house as a rental now. So you're going to rent out Mississauga and then move to Bowmanville. And let's say the house is $700,000. Your Mississauga house stays as is. You don't have to put any more down payment on it. Like the mortgage stays as is.
Mm-hmm.
And you just leave it and then you find a new house in Bowmanville. The minimum down payment you would have to have on that $700,000 house for Bowmanville is $45,000. So 5% for the portion between 0 and 500, and then this house happens to be 700, so an extra $20,000 down payment.
Awesome. Sorry, one more follow-up question on this. What if I move from locality A in Mississauga to locality E in Mississauga?
No difference. Same answer.
Oh,
Although
really?
I doubt you're finding a house for 700,000. Yeah,
Of
it's
course,
not
yeah.
that it's same difference. You need the minimum down payment on the new house.
Oh, I didn't know that.
Yeah. A lot of people think it's a first-time home buyer rule, but it's not. It's not. Now, the only catch is with the new rules that got implemented in the fall, if you buy that new Bowmanville house or location E in Mississauga, you have to amortize the mortgage at 25 years or less if you're buying with minimum down and you're not a first-time home buyer. So that would be the only catch, is you would need to be able to qualify that mortgage at 25-year amortization.
Oh, wonderful. This is completely new to me.
I know. Like I said, I feel like the media and how people communicate is incorrect. Like I hear realtors all the time say, oh, you need 5% down. And even if you're first-time home buyer in a $700,000 house, you need that extra down payment. So one of the other questions you asked me was the mortgage default insurance. So in Canada, when you have less than 20% down and you buy a house, you have to buy something called mortgage default insurance. It's the law. You can't get around it if you have less than 20% down. What that insurance is for is it protects the lender if you don't pay the mortgage. So if for some reason you don't pay the mortgage, the lender is protected because you have bought this insurance. It's quite expensive. It gets rolled into your mortgage, but I'm doing one right now for someone that's buying an $850,000 house. I was just looking at this morning. They have 15% down, and the mortgage default insurance is $27,000. So it's a lot of money. It gets added to the mortgage, so it's not that you have to pay out $27,000, but it gets added to the mortgage. If down the road you don't pay your mortgage, what happens is the lender gets the money for the mortgage. So the lender is protected by this insurance company. There's 3 of them in Canada. They will get the money for the mortgage that you haven't paid, but the house would still go into default and foreclosure. So it's not like you would be like, oh, great, now I have this house that I don't have a mortgage on, or I don't have to pay. You would still end up losing the house because you haven't paid for the mortgage. So it really is only protecting the lender.
Oh, so let's say if I defaulted on my mortgage, they have decided to, and let's say this thing kicks in. So I'll be at loss. So let's say if the house value has increased, will I be getting that extra amount, or that will also be gone?
So what happens when you default on your mortgage? So let's just use that $850,000 example. And by the time you're defaulting on the mortgage is worth 600,000, just making that up. But what happens is the house gets sold, and any money that you owe to people that's attached to that house gets paid off first. So the mortgage of 600,000 would get paid off. You would be left with the difference. However, their goal is not to get the most amount for the sale of the property. So they don't have a realtor out there working for you. You don't get to pick your realtor. They pick one for you. If there is money left over, for sure, you would get the difference between what you owed, all the realtor costs, all of that. But it's not as good as if you sold the house on your own, because you would be in control of how much it would be selling for.
Awesome amount. So not
Yeah.
awesome. Also, I meant to say like
Yeah.
awesome for the answer, not for the situation.
Yeah, definitely don't. It's not awesome if your house is being foreclosed on, but yes, definitely.
Yeah, because this is something which everyone has to know. People who think, okay, I've got mortgage insurance and I'm covered. No, you're not covered. The only person, or the not person, the only system which is covered is the lender who's giving you the
Yep.
loan. So you are
Yep.
at loss by default the moment. So
Yep.
you have to be, proactive in understanding what is that you can afford, what is that you're getting into. You have to have all the analysis done before you get into the mortgage.
Yep.
Cool.
Yep.
Okay. So before I get into the next topic, I want you to give me five, strategies which a first-time home buyer can follow so that he or she could get the best mortgage and best rates possible. Just five. Thank you.
Okay. The first is getting that pre-approval as soon as you know that you want to start shopping, because that will make you be in the best position to actually buy down the road. So even if you're not going to buy a house for 2 years, I recommend you get the pre-approval so that you understand what you might need to do differently if for some reason you can't get that amount you want. The second would be opening up a first home savings account here in Canada. That allows you to save $8,000 a year tax-free, and you can end up putting it down on your house when you purchase the house. The big thing I recommend for first-time home buyers is don't be looking for your forever home. So I think when you're buying your first house, you need to be open to something that might need a little bit of renos, might be a little below your price point, but also looking at different ways for you actually to be able to purchase the house. Maybe you need to find a house that has a rental unit in it. Maybe you want to be able to have a co-signer or a guarantor, but don't look at that end house as if it's your kind of end goal and needs to be kind of the best thing you've ever purchased. And last but not least is just making sure you're following the plan to get into that house as fast as possible, because, and I'm not just saying this as a mortgage agent, you definitely want to be getting in the market as soon as possible. Just with the way the houses are appreciating, it's better to get in one sooner rather than later.
Thank you. Thanks a lot. One follow-up question with the points you have mentioned. What is this first-time home savers account?
Yeah, so it's a new program. Unbelievably, that this is the third year we've had it. It feels like they just created it. But basically, it's a savings account that you can open up in Canada where you can contribute up to $8,000 a year. So it doesn't have to be the full 8,000, it can be less. And any taxes you paid at your work on that $8,000 when you made the $8,000 will get rebated when you do your tax return the following year. And then any money that you earn in that account as that money grows, because you actually want to invest it, is actually tax-free as well. So you could put $8,000 in, get a tax return back from the government of, let's say, $1,600. And then any money, if that $8,000 grows to 10, you can take all of that money out tax-free and then put it towards a down payment or just closing costs on the house. A lot of people think you have to put it down on your down payment. You can buy furniture with it. You can pay for the lawyer. There's a lot of things you can do with it.
Thank you. This is the first time again. So you are already proving to be a good guru. Okay. Now that we are covered with the first time home buyer stuff, so I want to get into the interesting thing out here, the difference between variable mortgage rates and fixed mortgage
Mhm.
rates. And how do I, being mortgage agent yourself, help me out understanding, what is at, how should I put it? What is at my best interest? Is it variable or mortgage? And how do I pick that based on the economical situation of the nation? Because interest rates are going up, going down, recession could come, could not come, and now the
Yeah.
tariff war is also happening.
Yes. Yeah.
So what is the best way?
Okay, so I'll explain fixed versus variable first, and there's two types of variable, so I'll explain those as well. So a fixed rate is an interest rate that you sign up for at the time you do your mortgage, where it doesn't change for the life of your mortgage. So in Canada, we do what's called a term for your mortgage. Usually right now we're doing between a 3-year and 5-year term, which means whatever you agree to do it for between 3 and 5 years. At the end of that 3 or 5 years, you can change it and do whatever you want. You can switch to a different lender. So you could go from Scotiabank to BMO. You can go from variable to fixed. You can do anything you want at the end of that term. So a fixed rate mortgage is where your interest rate is staying exactly the same for that whole term, whether you pick 3, 4, or 5 years. A variable rate mortgage, the interest rate changes throughout that term of the mortgage. So when you hear on TV that Tiff Macklem or the Bank of Canada made a rate announcement, those rates that they're talking about are impacting variable rate mortgages. So in January, they announced a 0.25 decrease to the variable mortgages, basically, for all intents and purposes. And there's two types of variable rate mortgages. One, your payment changes the following month when there's a change. So if you were in one of those mortgages, when they announced a 0.25 decrease in February, everyone's variable rate mortgages, that those types of variable rates went down by 0.25, which is about $15,000 of savings for every 100,000 that you owe. There's another kind where your payments stay the exact same, which is awesome because you don't have that like, oh my God, what are my payments going to be this month? And what happens is every payment that you make, if the interest rates are going down, more of your money goes towards paying off the principal of your mortgage. If the interest rates are going up, more of your payment is going to pay off the interest. So it's kind of like a balance between knowing what your payment's going to be every month and also getting the benefit of potential rate decreases. Does that make sense for the two types of rates? Okay. So it's challenging to try to figure out kind of which one you want to go forward with, and it's not a black and white answer. I mean, I don't have a crystal ball. I wish I did. I'd be pretty a rich person if I did. A lot of it does depend on what's happening with the economy, and we're in February 2025. And there's a lot going on in the economy and in politics, both on the US and Canadian side of the border. So there is a lot of uncertainty, one of which is the tariff conversation about if they're coming, when are they coming, how much, things like that. So right now, believe it or not, the fixed rates are actually dropping a little bit because of those potential tariff wars that are coming. And the variable rates, we haven't had another announcement yet. That should be coming in March. But it does depend on your comfort levels. There's some people that I deal with whose budgets are very tight. They might be a single mom. They have a very tight income, very tight budget. That's not someone I would be recommending take a variable rate, because even though they are sort of have been going down, tomorrow if something happens and there's another war that breaks out and all of a sudden those interest rates start to rise, that's someone that couldn't handle that change in their payments. Versus there might be someone that has a lot of extra room in their budget. They may be someone that wants to take a variable rate mortgage because they want to potentially get those wins. The other thing people don't know is right now variable rates are still higher than fixed rates. So a lot of people, like, the variable will have to come down quite at least 2 more times to be able to equal to the fixed rate that we're able to get right now. So you have to take that into consideration as well, because you're automatically canceling out some savings because you're already paying more than the fixed rate would be. Does that answer your question?
Yes, it did, indeed. So, taking this a bit a notch up, because the current situation, let's say if back in 2022 or 2021, the people who have got mortgages, they've got pretty less rates.
Mm-hmm.
1%, 1.2, 1.25,
Yep.
1.75, not more than two. Some
Yep.
people, unlucky people, got two at that time. But
Mm-hmm.
now interest rates are far more. Like the
Yep.
mortgage amount will go far beyond what they are currently paying. So most of the mortgages are maturing. I mean,
Mm-hmm.
some of them already matured, and some gonna mature by 2025 mid, or probably by the end of 2025. By then, everything will be done, right? So
Yep.
what would you suggest, being, seasoned mortgage advisor or agent, what would you suggest to these people who are running into, increased mortgage amount? How do you think they need to maintain? What is the best approach for them to sustain the oncoming high mortgages?
Yeah, so great question. Definitely getting that a lot lately. So had some talking to someone this week that was 1.64. And to your point, interest rates are higher. They're in the low fours right now. First thing I will tell everyone is just because the mortgage rate has doubled does not mean your payments double. So they definitely are going up, but they wouldn't double, because a lot of people think interest rates double, my payment's going to double, and that isn't what happens. So I would just let you know that. The second thing is, so I would recommend seeing what those payments are going to be, because there are a lot of people super stressed out right now. Like, we're happy to run quick calculators to tell you, okay, if your mortgage renewed today, here's what the payment would be. And most of the time people are like, oh, that's not as bad as I was thinking. So it's not as bad. But let's say it is bad, or something's changed in your household that you can't handle the impact of that change. There are things you can do to lower the payments. So you can increase your amortization back up. So let's say in 2020 you took a 25-year mortgage, and it's 5 years has passed, so now your amortization is 20 years. You can bump the amortization back up to potentially 25 or 30 years to get a lower payment, which I am recommending to some people right now. Like, it's tough out there. Groceries are super expensive. Like, if you need a little bit of breathing room, we can totally increase the amortization. There's still ways you can pay it down faster by making extra payments. But again, if you need that breathing room, that is an option. Another thing people are doing is consolidating debt. So if, again, things have been super expensive. Let's say you have some credit card debt, line of credit debt. You can, as long as the numbers work, put that into your mortgage to lower your payments. So again, it does depend on the person, but I would say first up, see what the numbers are. You might be surprised they're not as bad as you thought. And then if they are too high, there are things we can do to try to bring them down.
Amazing. So basically, what you're suggesting is to watch out, don't get panic. The things are not bad as they appear to be, because even
Yep.
though interest rate doubles, you are not paying double the mortgage, right?
Yep.
You can
Correct.
still maintain that number. For sake of people who don't understand amortization, do you mind giving a little bit introduction of that?
So amortization is the length of time it takes for you to pay off your mortgage in full. So as an example, if you had a $300,000 mortgage and you took a 30-year amortization, you basically would be paying $10,000 a year. And then after 30 years, your mortgage would be completely paid off. If you took a 25-year amortization, you would actually be paying more per year, because in 25 years, your mortgage is going to be paid off. So the higher the amortization, the lower your payments, because you just are dividing by 30 years versus 25. So again, if you need a lower payment, that's where we would look to increase the amortization for you.
What is the maximum amortization period allowed in our nation right now?
So traditionally, with like a bank or like a person that just deals with mortgages, it's 30 years amortization. There are some companies that allow you to go to 40-year amortization. but I do find their interest rates are higher. So even though you have a 40-year amortization, the math sometimes works out to you might as well sort of just stay with 30 because the math is the same. But you can go up to 40 with some companies.
Makes sense because lender wouldn't lose his or her money. So that makes
Yeah.
sense.
Yeah.
Okay, I've got another tangential question to this. So let's say this is all about the houses, right? The residential units. So can I
Yep.
get mortgages for to buy commercial properties or farmlands or farm properties, or let's say I want to build a brand new, like I want to dismantle a house, run down a rundown property. I'm trying to understand besides residential properties, what are the other avenues for the mortgages, and how do I get the best rates and best mortgages for that?
So basically, you can, for the most part, like mortgage any type of property. So you talked about commercial. You basically would get a commercial mortgage. In those kinds of circumstances, when you buy a house personally, we're saying like, can you pay for the mortgage on your own or with your spouse using the money you have coming in? With a commercial property, what they're looking at is can that business pay the mortgage? So we actually look to say like how much is the business making, how much will the mortgage cost, and can the business pay the mortgage? You also mentioned so what we would call a construction mortgage. So if you're going to buy a piece of land and tear down a house or just put a house on there, you would need something called a construction mortgage. That's a temporary loan that's lent to you, usually for a period of a year, for you to do that construction. And then at the end, what you do is you then switch it into a normal mortgage at the end. So that's what a construction mortgage is, but you can definitely do that to build a house or tear one down.
Wonderful. I want to take one more add plus one to this question. Can you please take me through this construction mortgage a little bit deeper?
Yep. Yeah, for sure. So at a high level, what it is because every lender is a little bit different, but here's how they work at a high level is let's say you bought some land for 500,000 and it's going to cost you $500,000 to build a house. What they do is they have an appraiser come out to the property and they look at the house on paper that you're going to build. So you're going to build a bungalow with a pond, whatever. That's how much the house is. That's what the house is going to look like in the end. What they do is they make sure that by the end of that, the house is going to be worth kind of over $1.2 million because you're going to be in it for $1 million. And you need to have some equity at the end to be able to switch it back to a normal mortgage after. So the appraiser comes out, says, yep, this house is definitely going to be worth this amount of money. We agree we're going to lend it to you. And what they do is they release it in stages. So because one, you don't want to borrow all 500,000 at once because you don't want you don't want to be paying for 500,000 if you don't need it. And then two, what they do is they also make sure you are actually doing the work along the way. So usually it's 4 stages. They come out first to say, yep, the foundation is in. Okay, we agree we're going to give you $100,000. And they release the $100,000. They come back again and now they have the framing up. Maybe that was $125,000. He says, yep, it's up. We're going to release the 125 and so on. And then once it's basically complete, it really needs to be complete. The odd thing can be missing, but nothing major. That's where you would get you would come back with another traditional lender to refinance the whole thing and get a normal mortgage at that time. Because the construction mortgages, are more expensive and higher interest. So at the end, you want to refinance into like a normal mortgage.
That is the part I'm getting confused. So let's say if I have a construction mortgage and I get to bank ABC and I ask them to give me construction mortgage, they're going to give it to me in the chunks as you suggested. So the house is up now. So you're suggesting that, okay, now you get this house evaluated and then ask bank to give you loan on this new house, right? So how about the existing amount then, which I've already taken? Like, will the bank pay to the ABC bank?
Okay, so you in that example, let's say you bought a piece of land for 500,000, you put 250 down and you had a construction mortgage for 500,000. You owe 750 on that property. When it's all finished, we have an appraiser come in that says now the house is worth 1.5 because it's such an amazing build that you did. You can either ask for just the 750 that you owe, or maybe you want a little extra money to do whatever. Maybe you need a relaxing trip because you've been working so hard on your house. The new bank comes in and says, okay, we're going to give you $800,000, or maybe it's just the 750, and then you pay off the construction mortgage people with that new loan.
Awesome. Thank you so much. These are small hidden informations which are available only when you ask for them, right?
Yeah, oh, totally. Yeah, great question.
Thank you. Okay, let's go to the last part one question, because I know we are coming towards the end of the podcast. So one question which suffers me a lot, let's say mortgage is pretty easy for people who are into full-time jobs or have a constant source of income. But how would a person who is running a business, for example, he's a self-employed, or he or she has their own corporation, what is the best approach for them to get the maximum mortgage and get all the benefits of that of a full-time employee?
Yeah, so a lot of people think that it is harder to get a mortgage when you're self-employed. And the great thing is there's actually a lot of programs for self-employed people that not everyone knows about. Part of the challenge is, and this is one reason I recommend working with a mortgage agent, is not all banks have access to programs for self-employed people. So if you're just going to your own bank XYZ, they may tell you, sorry, we can't help you. You don't claim enough income or whatever the case is. It doesn't mean that if you didn't go to bank ABC that you would get that same answer. So there are lots of programs for self-employed people. The challenge is not a lot of banks offer them. So I think sometimes people are like, I bank with bank ABC. So I go into bank ABC. They tell me I can't purchase because I'm self-employed. There are a lot of other programs that other banks offer. So the first one, and I think the big thing with self-employed people is you make a certain amount of revenue in your business, say 150,000, but you might only be claiming 25,000 to the government because of the different programs we have from a tax perspective. So the first option that we have is if you're buying a house, we can actually state the income that you're making. In that example I just had, you were grossing 150 and then you're claiming 25. There's a way that we're able to show that you're actually making more money than you are claiming. The second option is there is a lender that, providing you have 35% down in the house, they will allow you to borrow almost double the amount that you're able to borrow. If you're incorporated, one of the benefits to being incorporated is you can leave money in your corporation. So you made 150, you only took 25 out. There could be $50,000 sitting there in your corporation. There's a company that will allow us to use part of that income. And last but not least, this is not one that's well known across the board, is we can actually just use your bank statements for your business. So in that person making 150 a year, we could use the bank statements to show they're making the 150 and use a different number as income as opposed to just the 25 they're kind of claiming on their tax return. So there are lots of options for self-employed people. You just need to be talking to someone that understands self-employed people.
Wonderful. So basically, either in all these scenarios, there is nothing that you're doing. You're not. What do you say? How should I put it? You're not making up numbers. You're just telling what is there. Because let's say if I have 150 per year income, and I'm going to use only 20,000 from it, rest of the amount is going to sit in my bank account. I mean to say corporate bank account. So you're going to show those numbers and tell them, okay, tell to the lender that, okay, this is the amount you have for this particular, or what do you call the borrowee. So this person has this amount in the bank, so you can look at that and then give a loan on that. Amazing. Okay, so the last question for our podcast today is, how do I select the right lender, and what is the impact of mortgage agent? So in this process, because by this time I've understood the mortgage agent or brokers have a very major role to play, because there are a lot of things
Mhm.
which a layman wouldn't understand for sure, because I
Yep.
have learned great deal of information so far. So, but then just to, it's kind of summarizing the whole discussion which we did so far. So help me out
Mhm.
by telling me, how do I select the right lender, and how do I actually select the right mortgage agent for myself?
Yeah, great question. So I'll explain first how a mortgage agent works because a lot of people don't understand. So I'm a mortgage agent. So I basically think of me as a matchmaker, and I didn't wear this heart shirt on purpose, but think of me like a matchmaker. I take the client, so you in this example, and I match you with the best lender for your situation. So we've talked a lot about things like people that need to bump up their amortization on their renewal because they want some payment relief. We've talked about self-employed people. I basically match you up with the companies that will do what we need for you in your situation and have those programs available. I get paid by the lender because a lot of people ask me, how do I get paid? So I don't charge a fee. I know some mortgage agents do. I don't. I get paid by the lender. So whoever I match you with is the person that pays me. And again, I am just kind of finding out the programs that are there. So as opposed to you going into bank A, bank B, bank C, bank D, and finding out who will lend you the money you need, I do that for you. So I know all of those lenders' programs and can say, this lender does what we need to do for you, or bank A, C, and E do what we need. Let's pick from those. Sometimes you don't have a choice. So, and you just have to be aware of what the product is and be okay with it. So that's kind of how a mortgage agent works. Kind of think of us like that matchmaker, just like an insurance broker. So if you've ever used an insurance broker, you go to them and say, I need house insurance and car insurance, and here's my deal. They then say, well, here's who we recommend and why. But when we go to pick the right product, which product and lenders, because it's not just about like bank A versus bank B, it's both about the bank and then the actual product you're buying. Like you are getting a mortgage, which has different terms and things like that. So when we're selecting which is the option we're recommending and why, we look at a lot of different things. So a lot of people were conditioned to think lowest interest rate is the best. Well, the lowest interest rates available are actually on mortgages that you can't get out of. So you have to sell your house in order to get out of that mortgage. So again, if you are someone that's going to move in 2 years, I would never recommend one of those products because you literally, or you're going to need to refinance in 2 years. We won't recommend that to you because you can't refinance on that mortgage. So we're looking at things like, are you in a situation where you can pay extra down on your mortgage every year? If you are, well, then maybe we want a lender that does really generous prepayment options. That there's some that only let you put 10% down a year, but there's others that offer 20. Well, someone like that, I want to look for someone that offers 20. Maybe you need a line of credit down the road. I'm going to look for a lender that has a line of credit so that I don't put you with someone that doesn't, and then down the road, all of a sudden you need a line of credit. So it's all about the flexibility of the products. Does it do what we're needing to be doing? And then in the future, will it do something that we think you might need to do? Another example might be, you might be coming to me for a mortgage renewal right now, but in 3 years you're going to move. Maybe you're having another baby and by then you're going to outgrow the house. Well, I'm going to put you in a mortgage that you can take with you to that next property, because if I don't, you will have to pay a penalty to get out of that mortgage to move. So we basically take into consideration all of the different your situation and try to match you with the product and the lender that does exactly what we need it to do for you.
Wonderful. So a mortgage agent has a very major role to play for you to get into the right mortgage. And based on your requirement, he or she would work with you to get the things done for you. Amazing. Okay, we are at the end of the podcast,
Okay,
Laura.
good.
I want one statement from you.
Okay.
As the what do you say? In my language, Telugu, there is called Kosamerupu. That is at the end of the whole big saga. There is always something to take with me. So, as a seasoned mortgage agent, what would you suggest for someone who is looking for a mortgage? Like one statement.
I think it's really important when you're looking for a mortgage, both to not just focus on the rate, but focus on the solution and make sure you're finding someone that does that for you.
Amazing. Thank you.
Okay.
Awesome.
Okay, thanks.
Thanks a lot,
Have a good
Namaskar.
day.
You
Okay.
too.
Bye.
Bye.
Namaskaram everyone, welcome to CLTV Podcast. I have just finished a beautiful discussion with Laura. I learned a great deal of information about mortgage, processes, what are the things which we need to do as a someone who is applying for the mortgage, and certain tips and tricks for you to get better percentages in the mortgage, and what are the ways how you can apply mortgages for let's say you wanted to build a custom house, or you want to get the best percentage for your mortgage. All these kind of discussions were done in this podcast. I'm sure you would learn great deal of information if you're a first timer. This podcast is for someone who is interested, in buying their first house, who is interested in establishing their business by seeking mortgage help from banks or any other institution for that matter, from any other lenders. I'm sure you will enjoy this conversation if you're into investments, if you're into the first time home buying, if you're into business, if you're self-employed. I try to, not me, we both try to. I've asked a lot of questions and I've got wonderful answers from her. All her contact information will be mentioned in the description. If you want to reach out to her, you can happily reach out to her and get more information. And thank you. Enjoy the conversation with Laura Behm.